Good evening again, Canada, and welcome to week 6 of the Investor's Guide to Thriving for spring 2021. Well, as much of the country and indeed the world are under increasingly strict lockdown, the market has been breaking out, but with a good deal of sector rotation, which is where investing based on the right factors and asset classes becomes so important. But that's the subject of tonight's presentation, so I won't give too much away off the top. I will give away a little glimpse behind the scenes of what our team does. Many people think Larry works for BNN, but in fact, that's not the case. He's always been passionate about financial education, and so really he does the show out of love. But it's also pretty decent for business. Larry and I started ETF Capital Management together back in 2006, and at that time, we had just $10 million of assets under management. But today, ETF Capital Management is part of a much larger organization called Quintessence Wealth, or Q Wealth Partners for short. We're a cutting-edge fintech company and a partnership of portfolio managers managing over $2 billion and growing fast. We serve advisors and clients, plus we run some institutional mandates like the ETFs and funds of ETFs in partnership with BMO Global Asset Management. U Potential is our fee-only financial planning firm for those who only need planning, and Golden Girl Finance is our financial media site for women, which is also secretly read by men. And of course, the Investor's Guide to Thriving series is brought to you by Prosper Experiential Media, the in-house marketing boutique serving Q Wealth and its partners. When we bring you Investor's Guide to Thriving in support of childhood leukemia research at Sick Kids and Alzheimer's and dementia research at the Baycrest Foundation, Larry and I would like to thank those of you who have made donations already. And if you'd still like to make a donation, and we match all of your donations, please use the links in the survey you'll receive after the event, or visit investorsguidetothriving.com and use the links on the page. Well, of course, with all proceeds going to charity, your generosity and our event sponsors are the ones that make it all possible. And so a big thank you goes out to our partners in ETF education, BMO ETFs. No one exemplifies this partnership more than our good friend, Mr. Kevin Prinz, who I would put up there as one of the top ETF experts in Canada. So much so that he's been nominated for a special award called ETF Champion of the Year by Wealth Professional magazine. So ladies and gentlemen, who better to talk to you tonight about the features and benefits of factor-based investing with ETFs than a guy who, if he were a factor, would certainly stand for quality. It's Kevin Prinz from BMO ETFs.
Well, thank you very much, Jared, for that introduction. Wow. I'm so pleased to be back at this session. And, what I love about these sessions is the constant focus on education, right? And that's the key thing we're going to talk about today. Now, we'll highlight, this will be for information purposes only. You should always consult with a professional in the marketplace. And, beyond professionals, also do your own due diligence when you're looking at various investments out there across the board. With that being said, let's get into it. There, Jared. Yeah, disclaimer, there won't be any advice provided, to be clear, and there's not going to be any recommendations, just some good old-fashioned insights across the board. Let's start off with the insights right here with a really busy chart. And, our topic today is to talk to you about various factors. I'm going to dive into the concept of quality more than anything else. Now, when you hear the word factor out there, I know it sounds like an industry term, and good God, it is an industry term. But I want to dial it down a little second here. When you're looking at the marketplace across the board, you're knowing of the broad markets like an S&P 500 or a TSX cap composite. But quite often, sometimes you hear about value, you may hear about growth, different attributes out there across the board that various journalists talk about. When they talk about those attributes out there, what they're really saying is a basket of stocks that are following or basically have those types of attributes like value or like growth. Quality is another value out there, another attribute out there, and there's of course the general market factors. So what I'm really trying to highlight here in this slide is that investors across the board, you can access the broad market, you bet, and you're very familiar out there. But if you also want to maybe step aside from the broad market and identify yourself with maybe a certain attribute or a certain objective in the marketplace, there are also ETFs out there that cover that, like quality, like growth, like value factors out there. And what we're showing you here quickly on the chart, lots of financial metrics on the left-hand side, return equity, leverage, EPS growth. What I'm trying to highlight there are those, each one of those can play at different times a key part in the overall dispersion, which is the relative performance to the marketplace. So, you know, a quality factor or a growth factor or a value factor at different times in the marketplace can give you a different performance objective than the broad market across the board, and really aligning back with your individual objectives. Now let's dive in a little more deeper here. So for example, this is a really busy chart, and I love to give out busy charts, so I'm going to apologize for that. And really, unless you're an industry professional, I don't know how anybody reads this thing. So bear with me. What you're really getting here across the board is you're outlining some of those various factors I just mentioned about value, volatility, for example, size, equal weight versus market cap, for example, quality, that's the ones in red, momentum, growth. Year over year, as you see it across the top, what you're seeing is at different times in different market cycles, each one of these factors has different performance attributes to them based upon what's going on in the overall market, of course, right? Now, generally over time, you can see that different factors out there tend to have a more balanced approach in different market situations, because some factors do really well in some markets, some in other markets, and some kind of do a little bit okay in each market. So for example, you look at the quality factor here, which we'll spend some more time on. That's the ones in red. Generally, on average, you're seeing it above average across the board when it comes to a factor that provides exposure to the marketplace. It gives you a different profile in the broad market. So let's dive into a little bit here. What do you get when you get a quality factor, and what does that term mean? I'll spend some time on that too. Let's go to the next slide. And the next slide is really just kind of showing you performance, right? And when I talked about initially relative performance, because you can buy the broad market, absolutely, and you know of all the broad markets. And in addition, you can buy an objective-based ETF, in this case, quality. One thing you want to do when you look at these restrictive objective-based ETFs out there is take a look at what objective they're following, in this case, quality, is given a consistent level of different exposure and performance relative to the marketplace. So looking at various different markets, in this case, Canada, US, and the global marketplace, seeing that there's more of a consistent trend for that factor across the board. And you are seeing that with a quality, given that dispersion relative to the broad market in performance there. And I guess in this case, positive dispersion. Let's skip to the next slide. And this is just highlighting a certain period of time, and every period of time is different, like as we showed in that last chart there. So this is really for illustrative purposes, but what you're seeing here is that broad market being isolated in the middle there with that little X kind of or cross being placed over top of it. But then you're also seeing some of those more topical topics out there, or things you're hearing about there, like a dividend mandate out there, maybe a value mandate out there. Equal weight is a size aspect that you saw before in the performance charts. And of course, low volatility has been a very popular trend. What you're really seeing here is how they give you different objectives. You're trying to have less risk in the market. That's effectively what low volatility is doing, because you look at the risk on one side and return on the other side, you're seeing off the side. Now, it's still an equity, so it's not no risk, of course, but you're seeing that as an attribute in what you can pick up now through ETFs to build a portfolio. And quality being one that kind of sits into the middle, but a little bit higher in performance, a little bit less on risk relative to the broad market on average. And again, it's always based upon a certain time. Past performance does not indicate future performance. Let's go to the next slide. So we'll dive into that quality a little bit more, because where does quality sit in the range across the board? And what we're showing here in the color bar, which I want to pay a little attention to, the color bar is really kind of highlighting that trade-off, that risk-return trade-off. And so again, point in time is always key to think about when you look at these charts, because it never stays consistent. But at the point in time of snap, it's really showing you that a quality performance is kind of that middle ground, right? Where you have low volatility, as I showed in the previous chart, a little less risk than the broad market, a little less return, because that's just the trade-offs. Where you have on the other side, like a value, where you're going to get a little more volatility in there, and potentially a little less returns relative to the broad market, right? Well, a little bit more return, more broad market, a little more returns broad market, sorry. And quality kind of sit in that middle zone, but in there on the risk relative to return across the board. So it really kind of combines a few exposures. Let's go to the next slide to dive into a little bit more. And you know what, I'm going to skip past this one too. Let's get to the next one because it gets into more detail. So when we talk about quality, what is that? For a lot of people, quality is a net new term. And it's just another industry jargon out there. So what does the industry jargon does? It's effectively taking some key ratios and then layering them up to understand and isolate companies that have a sustainable competitive advantage in the marketplace. So first thing that, a quality factor we'll look for is return equity. Are the companies making money in this basket relative to other companies out there? Key screening. The other aspect it looks at is stability of earnings on a year-over-year basis. So is the earnings of this company's making, is it a one-hit wonder, or is it consistently delivering good performance on a regular basis? And the last thing it looks at is low financial leverage to derive a quality factor. And the low financial leverage is, a lot of companies out there can leverage up their balance sheet to get some really good numbers. In this case, it's looking at the other thing. They're not leveraging their balance sheet, they're actually growing their company by those return equity and that stability of earnings across the board. So that's what you're getting with a quality factor. It's really summarizing those three key ratios. Let's dive a little bit forward here too. Perfect. So what you're seeing now is I showed you a chart before with some nice cascading lines of performance. Again, this is a similar chart showing you relative performance, but showing you the performance of quality in respective marketplaces across the board, showing there is consistent performance over the period of time or outperformance period of time. Again, it's over a period of time. You got to expect that across the board. Let's go to the next slide because I want to dive into dive into what you see from holdings perspective. Perfect. So when I'm talking about quality, I talked about those three key ratios that goes with inside the screening methodology that quality looks for. By looking at the companies, you can see how it's pulling that across. So some of the larger companies would go inside a quality-based ETF or research mandate out there. Is something like a Microsoft or Apple, Johnson & Johnson. You all know these names, but these companies tend to have that sustainable competitive advantage out there, Google for that matter too. And that you can clearly see coming through from that ratio analysis we talked about a second ago. That ZUQ is one of our US quality ETF. Again, that's why I probably know the name so much, because US quality. You're still getting a diversified basket, but the basket itself will be set by that criteria of those companies. Let's go to the next slide too. Just showing you how that basket looks as you then cascade to a European view. This is ZEQ, which is holding a European basket across the board. Again, companies you might know across like Roche or Nestle across the board, Unilever. Again, companies out there that tend to have that sustainable competitive advantage and being diversified as a basket across the board. Let's skip to the next slide. Just to close off of, this is a global view. ZGQ is a global, so it's an all country, all world kind of one ticket solution for the world. And again, you're seeing those dominant names from the US and globally for that matter too, coming through in here because of that sustainable competitive advantage and specifically isolating those three key factors. Now, when you're looking at quality or any one of the factors out there, understand it's never one thing only. You're always going to pick up some general attributes across the board of the other factors too, because when you hold the basket, nothing is ever 100% value or 100% growth. It's always a bit of something. So when you're looking underneath the hood on quality, for example, what do you tend to get on average? You tend to get a little less volatility in the first bucket, right? That's pretty good. A little more momentum or a little more growth across the board, and a little less focus on leverage, as I mentioned already, because of that screening aspect across the board. So in essence, what you're really getting through a kind of a quality factor is that trade-off of a little more growth, a little less risk coming into a basket across the board. Go to the next slide. And again, showing you more historical performances here. this is showing you one of those key metrics that a lot of the industry professional tends to look at. What's the upside and downside capture ratio? By looking at this, you generally want to have a little more upside capture and a little less downside capture. You're still going to have a bit of both because that's what investing is all about, and not going to have all of either. We'd all like to have no downside, of course, but you're going to have that. But it's about that trade-off and finding that trade-off. So if you're looking for a way of investing, you want to maybe move beyond the broad market, you may want to think about quality as a factor to invest in. And if not, you can also look at value or growth, the other ones out there, to really change your portfolio dynamics from time to time to really meet your individual objectives. In this case, we spent time talking about quality as that factor. And let me cut to my last slide there, because I really want to highlight that, today you're going to have a lot of good education from Larry, of course. I'm hoping you picked up some insights about what quality is as a factor, things you can look up for your portfolio to line back up to your objectives across the board. If you want some more education, we actually run a weekly webinar ourselves on Friday at 1 o'clock. So tomorrow at 1 o'clock to 1:30. Happy to highlight our special guest. Tomorrow will be Kathy Wood from ARK Invest, and of course the MSCI too, who we partner with around a net new series of ETFs across the board. And one last thing I do want to highlight today, of course, is all about information and providing you some insights across the market. Always, one more time, touch base with professionals out there, and of course, do your own due diligence. With that, I want to introduce Larry Berman, because as Jared mentioned at the beginning, it's all about education. And I actually met Larry around education 20 years ago. Back then, he was actually educating professionals. And what I like about today is he's continued that motivation and focus on educating people. And let me hand it up to you, Larry, to take it from here.
Well, thanks very much, Kev. And that webinar tomorrow with Kathy Wood is not to be missed. I saw one with her maybe a week ago. She is clearly one of the, her team is one of the most in-depth, innovative way of valuing companies out there. One of the things Kev talked about is earnings trends and everything about the history of a company and has it got a good quality balance sheet. A lot of these new innovative disruptive companies that are found in the ETFs and indexes that Kathy's firm ARK runs, and BMO just came out with a index version of ARK, the ARK-K ETF. So very excited about ZINN. These companies are new, they're innovative. They don't have long histories of earnings trends. So, her ability to figure out what value is for these companies is really, really quite something. So not to be missed, guys. And again, thanks very much, Kev, for your insights and efforts and education and partnership over the years. And in fact, it was 23 years ago that we first met. So the clock is ticking, my friend. Okay, so what are we going to dig into tonight? So one of the things that the great things about factor ETFs, I'm gonna let the factor ETF do 90% of the work for me, and I'm gonna kind of drill into that and show you how I do that. First, I wanted to give you our weekly update on one of the factors in the Pro Eye series that's catching my eyes right now that I've been talking about, and that is seasonality, which we talked about a little bit in recent weeks. But the seasonal patterns in April are very, very strong, and in particular in the first year of a presidential cycle. So let me dig into that. I'm going to talk about earnings and profit margins and quality of earnings, and then we'll get into the Q&A. So again, if you haven't had a chance, do a Google search, Pro Eyes Berman's Call. You can't miss it. Tonight, I want to look at the factor of seasonality. Okay, and in our 20-factor model, valuation's important. Right now, off the charts, crazy. Business cycle, very supportive. What the Fed is doing for liquidity, very supportive. Now, starting to get a little bit frothy. One of the factors in the business cycle, credit spreads. We have not seen high yield credit spreads as tight as they are, and that's a major risk factor. So the markets are pricing in a tremendous amount of good news on the credit side, largely because of central bank support. So that's something to keep in mind. And of our tactical indicators, let's dig into seasonality. So the charts we present every week, the top part of the chart is the 1 month forward return of the S&P 500 in all years, going back to when we have daily data for US large caps, which is 1927. So this includes the Great Depression, and this includes the run up into 1929. And the tendencies around money flows and earnings. Now, it wasn't always earnings. There are reasons why there's seasonal patterns. For example, in the last number of decades around the quarterly earnings cycle, that was never a thing, 100 years ago. It was never a big thing anyways, but it's become a thing in the last couple of decades. And what we ended up seeing as a tendency in recent years is that in Q3, companies have a much better visibility of the current year. And if they've been overestimating, you tend to see a bit more downgrades. Plus, it's really the first time they start talking about the next calendar year with some visibility. And then analysts make their adjustments. And that alone is one of the reasons why Q3 and August and September in particular tend to have these negative seasonals. So how we set up the graphic there is that when the seasonal factors looking out a month are positive, our indicator is in the opportunity zone and down at the bottom and around green. And you can see as we're in early April now, very, very strong seasonals. As we end April and get into May, you've all heard about sell in May and go away and that kind of thing. Because basically from May through to the bottom in September, on average, there's not a lot of gains to be had from a seasonal factor. It doesn't work every year, doesn't work all the time, but as a general guideline, it's one factor for us of 12. Actually, it's 2 parts of 12. So 1/6 overall. Now, the second aspect of seasonality, so this is all years combined, is to look at the presidential cycle. This is a unique thing to the US markets. Canada doesn't have a prime minister cycle. Our elections are called at random, but have to be within 5 years of the last election. Those are the rules. And the parliamentary systems around the world, Israel's had 4 elections in the last 2 years. Maybe this was the 5th one, I can't remember. Italy has had 23 elections in the last 10 years, something like that. So the presidential cycle is unique to the US market. And given that the US market is 58% of the world, it matters a whole lot. So we're in the first year of the presidential cycle, and money gets spent by Congress, and this time in particular, through reconciliation. So a lot of stimulus now, and theoretically, in the first year of a presidential cycle, depending on the control of Congress and whatnot, you tend to get a better first half than you do a second half. As you get into the second half, they start worrying about the midterms and perhaps losing control of Congress, which is going to be a very, very big risk given the colossal amount of stimulus that's coming in. Now, first year of a presidential cycle, you could see there the seasonals were very, very negative. Let me go back a page. They're negative in general for February, but in particular in the first year of a presidential cycle, sorry, I clicked the wrong button, they're even more negative. Not negative 10% or 20%, but on average negative a couple percent lower. And again, when you smooth it out over time, you're talking about a few percent up on average and a few percent down on average. This doesn't tell you a crash is coming or anything like that. It's just a tendency around money flow. That's it. And so now into April, again, very, very, very strong seasonals, We get a little bit of a lull in May, as we tend to do. Then we get another bump. But Q3, in the first year of a presidential cycle, looks really, really bad. And Q4, that normally is very, very strong, is not very, very strong. So I'm looking for problems in the market. I'm looking for them in Q3 and in the back half of the year. So fundamentally, I say, well, what has to happen? Well, we've got all the stimulus, which they were going to pay for, this the 900 billion and now the 1.9 trillion. But when Janet Yellen took over Treasury from Steve Mnuchin, there's a huge cash balance. And what they chose to do is take $1.5 trillion from 1.9 and run it back down. So there's currently about 500 billion left to spend that they haven't. On May the 4th, we get the next Treasury announcement for what the issuance schedule is going to be for the next quarter. So February, May, so every 3 months, starting February, May through the cycle, that's when the announcement is of supply for the next quarter. Now, historically, foreigners bought 43% of the US Treasury auctions. In the last few years, that number is now below 30%. So who is the buyer? Is it mom and pop retail with a 1% yield on a Treasury bond or a 0.5%? No, it's not. So you've lost a huge amount of international central bank buyers, and you've lost mom and pop retail. So who's buying the bonds? It's the Fed. And so in the second half of this year, the imbalance on what the Treasury is going to need to have in cash compared to what they have to issue is, we'll find out May 4th, is somewhere between 2 trillion and 2.5 trillion. It's a big number. And that money's got to come from somewhere. So right now, that money is going into equities because the primary dealers that trade bonds and everything, there's just not a lot of supply right now. In fact, right now, the Fed is buying more treasuries every day than they're issuing. Supply and demand is very positive right now, and why capital markets have responded quite favorably. That continues for another month. We also have the reopening excitement, and we also have earnings, which are likely to see good upgrades by companies as they start reporting next week. So markets are good for now, and we've reduced the hedges on our portfolio, and we want to get as much upside as possible. But at some point between now and June, July, when the seasonal start to turn really bad again, I get very, very concerned about, a 10 to 20% type correction. Now, if we're at 4,200, 4,300 on the S&P, I think closer to 4,200 might be the cap here. But if we're in that range and we get a 10%er, that takes us back to 38, 37, where we started the year. No big deal. If it's closer to 20, we go back a whole lot more. But I think it would be in that range. It's all going to depend on what the Fed policy response is. Are they going to up their game? Are they going to initiate yield curve control? So the seasonal factors this year tie in tremendously to the fundamental money flows. Now, a friend of mine, Don Velo, and his son now John runs this. I put a link here. They have seasonal patterns for not only the S&P 500, but for lots of assets. And you can go look at seasonal patterns there if you're interested in that. So it's a way for you to follow along at home. So let me get into earnings and let's start cutting to the bottom line here. Kev talked about a bunch of factors, return on equity, all kinds of numbers that fall into when you're screening for companies. So MSCI says the quality factor is outlaid as Kevin mentioned. These are the attributes we're looking for. Not looking for value. We're looking for less leverage, so clean balance sheets, not a lot of debt. These days, a lot of debt probably doesn't matter, but if we're going to get inflation and rates are going to go up a little bit, companies with bad balance sheets are going to suffer, right? So I love the quality factor because it gets rid of, for lack of a better word, a lot of crappy companies that are only working and generating revenue because money's cheap, right? Because they can leverage up. When you talk about, earnings per share and profit margins, this graphic caught my eye this week, and I thought I'd share it with you. But it looks at labor share of income. I've talked about this before. There's when you look at national income, federally government income, the income of the economy. So when you look at GDP, you have gross national product, you have gross domestic product, and then you have real, after inflation. So those are, but that's the output side. The input side, supply side, is incomes, because it's all those incomes that generate the buying power to produce, to consume, right? So the consumption side and the income side. So on the income side, there's capital share of income, which is economic rents, and whether that rent is from owning a property and charging a rent for it, or whether it's a rent from lending your money to a company or a government and getting an interest payment, or a dividend. It's capital. It's your capital at work. So there's the capital side, the wealth part of income generation, and then there's the labor share. And for the last 40 years, labor share of income, the scale is inverted, has been declining. And this is inequality. And as inequality factor, okay, there's the word factor again, has increased, profit margins have gone up. A huge variable in the profitability of a company is wages. And the after-tax profitability is taxes. Those are two things for the next decade or two or three that are going to be under stress, because governments are broke everywhere in the world. Taxes are going up on a personal basis. They're going to go up on a corporate basis. I'm not advocating for this. I'm not saying it's good. I'm just saying here's where we are, and these are the policy responses we're going to end up seeing. Labor share of income is going to have to go up. That is a critical factor in fixing inequality issues. Now, there's all kinds of inequalities, and I'm not talking about racial inequalities, but in general, incomes fall into that category. So profit margins are going to get squeezed, especially if inflation starts to take hold, because that's going to put the cheap financing at risk. And companies with bad balance sheets, i.e. not quality companies, are going to suffer more. So when I look at a quality factor ETF like Kev highlighted tonight, and I say, okay, U.S. large caps, S&P 500, let me go to ZUQ, and I'm going to pull out 125 or so names of the companies that have the best earnings trends, like you saw the names that Kev highlighted there. It doesn't speak to their valuation. It doesn't say that Microsoft trades at a forward multiple now of 30 times earnings and historically traded around 23. Doesn't speak to that. It just says earnings growth is good, quality of their balance sheet is good. Doesn't speak to valuation, okay? Very important to understand, because Kev talked about different factors, and value, low P, low price to book, is a value factor, not a consideration under quality. So when I like the quality factor, I say, okay, now if you're looking for names of good quality companies, go to the BMO website, look through their ETF and say, hey, these are good companies. MSCI and all the smart indexing people in the world have already vetted these. They've gone through the financial statements. They've looked at them. These are good companies. So buy the basket and get them all, and be diversified, and that's a great way to do it for the average person. But if you like your stock selection, take the universe of great quality factor companies and trade those names. So when they get overbought, technically that's the value side for me. So I'm going to show you my process a little bit on this. So this is the chart I showed on the show this week, and we looked at FactSet. FactSet goes back over history. Prior to COVID, the earnings per share target for end of 2021 was about $200 in earnings per share. Right now, that number's ballpark, $174, $175. We think, based on upgrades that we're likely to see over the next quarter or two, that number can come closer this year to 180. I think the multiple right now is very high. 20 to me is high, but let's say we get 20 is okay. So a 20 multiple on 180 gives us a target of 36 for the S&P. So when I say we're going to go to 42 or 43 and we're at risk for a correction, that's what I'm looking at, right? Where would we be if things normalized? If interest rates get forced up and the Fed doesn't go buy those extra bonds, then money comes out of the market. This is kind of the back half of the year scenario that I'm thinking about right now, and why I want to do some hedging in the next month or so. Not today, not tomorrow. This is not go to cash. This is moving to an innovator type strategy. So in the funds that I run for BMO, and one of the things we do for our clients at ETF Capital, when we think the risks are high, we put on these buffers. We buy the insurance with puts and use option strategies. I've talked about them for a couple of years now, but really I'm highlighting them and I'm drilling down this to everybody every week, because I think this is a really important way for you to continue to participate in markets and maintain that balanced kind of risk to your portfolio without having to use bonds, because I think bonds are not broken, but they're severely impaired. David Costin, who's the chief equity strategist at Goldman Sachs, today on Squawk Box, said Biden's proposed tax increases would take a major bite out of earnings numbers. That's not in the market. So that's another thing. And then in 2022 or 2023, we hit this fiscal cliff where if Congress flips, we're not going to be able to spend all this money. And we hit this fiscal cliff where the stimulus isn't going to be there. So, you know, I think we're getting very close to a bit of a volatility event, a risk event here. But a year ago, before COVID, the S&P with a 200 price target this year was at 32.30. And that's the scenario that's the more like the 20% correction, right? So those are where we're thinking we're okay, probably through early May. That funding announcement from the Treasury, May 4th, that's a key date for me. So we'll see how all that goes. Okay, so I want to look at Tesla, and I picked Tesla specifically because I love the car, I love the product, I love what Elon Musk is doing in terms of innovation and batteries, but I speak to valuation. And I knew Kevin and BMO were doing this webinar with Kathy Wood, and I've said that despite her great research, she put out a target for Tesla 5 years from now, 2025 target, where their base case scenario, I think, was 1,500, and their bull case scenario was 3,000. Listen, I don't agree, but that doesn't matter, right? I'm looking at today, do I want to own Tesla and buy it and trade it? Tesla does not fall into the quality basket, by the way, just saying. Okay, so when we look at, but largely because they don't have a long-term trend of earnings, they just started making money. Okay, so that's the primary reason. And they have a lot of debt too, so that would be another reason why it wouldn't necessarily fall into the quality basket. So when we look at the bulls and the bears, I look at the analyst price target, but here's where the consensus is out to lunch. So you can see the 12-month forward target. So to the end of this year target for Tesla, $650.61. And the last trade as of last night's close, I think I printed, might have been 2 days ago, around 671. But the bulls, if you look at the people who are buys, 17 names there, look at their price targets. They start at like 800 and go up to 1200. So the bulls think it's worth 900 or 950 1 year out. Remember, Kathy's at 1500 base case, 2025 target, 3000 bull case. But look at the bears. The people that think Tesla is just a car company and should be trading not like a tech valuation or an innovator, but trading like a car company. Listen, I fall into that category, guys. Their average target, 300 and change. So half. So the average is 650, but that's not consensus. If you're a bull, it's 900. If you're a bear, it's 300. And that's the problem with Tesla today in trading it. So I've been writing puts on Tesla around 400. I think, okay, at 400, I'll take a punt, right? So I've been writing puts and earning premiums on Tesla for a number of months now. And no problem. I earn 1% a month while I'm waiting to buy it. So we'll keep that up until we buy it at the price that we think is more reasonable. And that's kind of how I think of things. But then I look at the technical side. Okay, so let's say I figured out I want to trade Tesla, right? For whatever reason, and it's not on valuation, right? It wouldn't be on valuation today. So, we can look at the earnings, we can look at growth, but you can't value this thing based on earnings today. Like, you got to take a Kathy Wood approach and value it based on what it might be worth down the road, because today it trades at $500,000 per car that they're going to deliver this year. And they sell the average car for what is $60,000 US. I don't know what, 70. So it's trading at a gross multiple of revenue. And it's just too hard to figure out the earnings story there. So, when you look at a price chart, here's what I see. So this company can correct a couple different ways. That trading range on a log scale here that looks really narrow is 100 down to 40. It's a 50-60% trading band. So if you apply that today, that's 1,000 down to 400, right? So if we come out of this bull channel that's defined the last year and a bit, highlighted there in red, technically it starts to break down. How does it correct? Does it go straight down? Does it go sideways? These are things nobody knows. But the historical behavior is these multi-year bases, a re-rating or revaluation of the stock, a consolidation, broad trading range. What's coming next for Tesla? My book, broad sideways trading range, not up. Can be traded. The bottom end of that range, maybe 300-400 based on where the bears think it's worth. And the upper end, maybe 900-1,000 where the bulls think it's worth, certainly over the next year. And there's no problem if you want to trade it in that kind of range. Okay, so being in the middle of the range, how much do you own today? Answer, trade half a position. Bottom end of the range, full position. Upper end of the range, a quarter, a third, smaller number. And that's how I do it. That's how I figure out how much of this I want in my portfolio and how I'm going to approach trading it. So let's look at the risk side. 3 types of risk, right? So you've got idiosyncratic, which is the risk of the company not executing, of Elon Musk not, listen, we talk about Bitcoin. I'm not the Bitcoin guy, as you know. But if you're the CEO of a company and you're taking the treasury of that company. You can debate this with me if you like, but you're speculating in Bitcoin with the treasury of your company, the capital of your company. I don't care that money doesn't pay anything. This is the capital of your company you're putting at risk and speculating. This isn't T-bills. This isn't government treasury. I get the argument for Bitcoin. I do. I heard a guy today on Bloomberg, not the Canadian TV. I listen to the US radio show. I like that better. But he thinks that 5% of every CFO is going to put some portion of the company treasury in Bitcoin. So who knows? And if that happens, it's going a lot higher. So the idiosyncratic risk is the company and the officers of the company doing something that doesn't execute. It's the problem. And it could be a product issue where they're not good enough versus the competitors, so they're losing market share, something like that. Okay, it's not, I can't get enough microchips, because that's everybody's problem in the industry. That's an industry problem, right? So on the industry level, it's changing consumer behaviors where, because of innovative technology, if you're not producing battery-powered cars as the core part of your fleet 5 or 10 years from now, you're not selling many cars, right? So that's an industry thing, but crosses over a bit with company-specific risks. And then there's systemic risk or systematic risk, and that is things to do with the economy, growth and inflation, and the business cycle. Meaning we're in a recession, everybody's doing bad, markets go down, multiples contract. So there's 3 types of risk you need to consider. And when you look at an analyst comment on a company, and if you read them through, they've got, oh, and here are the risks. And they talk a lot about idiosyncratic, the company not executing, not meeting targets. They don't talk much at all about systemic risk, and they talk a little bit about industry risk. The company's beta, or its sensitivity to the market. So a company with a high beta that does what the market does, goes up and down with the market, it's very highly correlated. That is very attuned to systematic risk. Less so on stock specific industry. A low beta stock, it has much more to do with the industry, with what's going on in the industry, utilities, mining, things that aren't necessarily as correlated with the broader economic trends and company specific risks. So beta is a really key factor, for me. So here's a stock we just bought and why. So I like the reflation theme. I like the theme fundamentally of infrastructure. I think it's, really, how do I put it? Again, I'm looking at the analyst target here for tech, but the fundamental story needs to make sense. There's got to be a reason for seasonality. There's got to be a reason it's going to work. You can't just be about, so I like that. It's not for everybody, but there's got to be a fundamental story for why earnings are going to keep growing. The bottom line, it's earnings. It's a multiple of earnings, and that's a volatility thing, that multiple, but it drives the trends. So tech is coal for steel production, a huge part, bit of oil and gas, zinc, nickel. These guys are the poster child for rebuilding America and the world. And I think, for years, people would call in on BNN and ask me about tech. And I say, China's on the flip side, tradable rally, not investable. I think for the next 5 years, it could be investable. Tradable for sure, but I think investable. And so I just put this in our stock portfolio, 1750-ish, 40-ish. We just bought it last week, 2 weeks ago. So what are the analysts saying the price target is worth? And you can see their price target is $24.50. So I like to know fundamentally what the analysts think, but then I look at my charts, right? So I have multiple price targets. I have fundamental targets and I have technical targets. When I look at a chart like this, so at the top, I'm looking at a multi-year going back to the great financial crisis on tech, right? So, best case historically, what did this stock do? And it's a commodity-based stock. It's cyclical. It goes up and down, tends not to be a growth story, right? It's cyclical. And as that cycle is in favor, which it is now, and probably will be for a couple of years, as we spend and get into that rebuilding, the bridges and the dams and everything else, tech is going to be a big beneficiary of that. ZMT is an ETF that I started talking about last year. I highlighted this double bottom pattern a year ago and said base materials, this is a great potential trade here at a minimum. And we started adding this to our growth portfolios. I trade the positions around. I recently lightened up. I actually bought ZMT back. Now, tech is actually not in ZMT. But again, what BMO is doing is an equal weight basket to aluminum companies, steel companies, mining companies, base metals and copper and so forth. So it's a great way to filter for these names. I think tech is the poster child for reflation and for infrastructure. That's why I picked that stock. So when I look at these charts and I go back and say, if we're only half of what we did in 2010-11 when we came out of that recession, what's the upside here? And it's way, way, way higher than where we are today. So I think analysts are light here. And so this is a name I like. So again, relative strength is then a key criteria for me. So I look at how is that stock performing, and I look at it relative to a benchmark. And so I chose the benchmark for the mining and reflation trade as ZMT. So what we're looking at on the top there is a percentage, going back 5 years, percentage increase. ZMT, you can see, is the orange line. Tech is the white line. So basically when the white line's going up at a faster rate than the orange line, my bottom ratio is rising. It's outperforming the benchmark. So it's cyclical. It goes up and down. I like to buy on pullbacks. So we recently had a relative pullback to approximately, if you look at the bottom chart, where the base was on the breakout just around, late last year when it became clear to me anyways that Biden was going to win the election and that infrastructure was going to be a big part, green infrastructure, but infrastructure nevertheless, a big part of the reflation trade. Copper started to be, green energy, batteries, electrification of cars, 150 to 180 pounds of copper in an EV, 30 to 50 pounds of copper in a combustion engine car. Where's the future? Copper demand. Okay. So that's kind of my process on how I go about picking stocks. And so I wanted to do a feature because we're getting a lot of questions that have come in. I've talked about these buffer ETFs and how to use them. So again, reiterating what they are. They buy a degree of put protection. So you can see on the left-hand graphic here, current market. So the April and March, so recent new ETFs that have come out, they recycle these every year. So on April 1st, where's the S&P 500 trading? The buffer buys a put spread at the money, 9% downside protection. So that downside line, put protection's 9%. If it falls within that next year, anything less than 9 by the end of the year, you got 100% protection. And to pay for that upside, you have a cap, and it shows you the ETF level. So the S first line there, the B April, that's the 9% protection. The upside cap remaining as of the other day when I printed this off, so I think it was as of the close yesterday, had 12.34% before the cap kicked in, before the covered call sold away the upside. You get no more than that if the S&P goes up more than that. The degree of protection before you hit the buffer. So 1.15 downside before that buffer kicks in, and then the buffer protection below that. So the degree of protection below that. So that's how you kind of look at the table here. I know it's mind-boggling. And then you have the 15% buffer. They call them the power buffers. And that put protection's 15%. So within the next year, from April 1 to March 31st next year, if the S&P on March 31st is down 14.5%, you lose nothing. The put gives you 100% protection. If it's down more than 15, that's when you're at risk. It only protects the first 15. The ultra buffer protects 30% of the downside, but not the first 5%. So you're always going to lose at least 5 in a down year of 5 or more, but you're going to protect the next 30. So if the market is down 35% March 1st next year, you're down 5. But you get to participate. So right now, if you're worried about the upside, these are great, because if it doesn't go down and keeps going up, you get more upside, right? So you have 4.8%. Now, there's remaining cap 5.9% for the ultra buffer. The more protection, the less upside. The sweet spot is that 15% buffer, because if you've listened to me over the years, you've heard me say that the average correction for US large cap stocks, where we have daily data going back to 1927, is 13.4%. So the 15% buffer on average is going to protect you most case scenario. So these are great products for the current market environment. I love them. We do these for clients. We can now do these things in our BMO strategies. And I'm very, very excited about that new addition to the funds this year. Okay, something we were never able to do before, because what we did before was we moved to bonds. We moved to things that were more defensive. Turns out gold wasn't defensive the last 6 months. It's been awful. Gold equities. Historically, very uncorrelated with stocks, but it hasn't been a good hedge. Bonds, last 6 months, a horrible place to be. The traditional way of protecting portfolios hasn't worked. Now you can go to cash, but you don't get paid for it, right? And this is what we hear every week from people. Larry, where can I put my cash? I don't get paid. Buffer ETFs. These strategies and what we can do now in our BMO funds, and we've been doing for a couple of years for clients in our strategies at ETF Capital Management. Okay, let's get into the Q&A tonight. So first question, innovator ETF. So hopefully what I talked about gives you some insight into how to read those tables. Because yeah, they're these defined outcome ETFs. There's a lot of videos there. They got a lot of education, a lot of learning. I strongly encourage you to understand how to use these and how to trade them. I talked last week or the week before a little bit on how to trade them. Next week, I'll do a little bit more on how to be tactical with these strategies. Okay. Would I suggest investing in a European ETF at this time? Would I recommend hedge to CAD? Which ETF? So I've said for years, I love the high dividend. So Kevin talked about factors. ZWE, ZWP, high dividend stocks in Europe. Some of the best dividend payers out there. The dividend factor is underperformed for quite a while. But you get a higher yield, and you get the covered call bonus, and you get a bit less volatility. Now, they didn't protect at all. at all because the speed of the decline was so rapid, after COVID hit and the world shut down so quickly, that a covered call ETF wasn't giving you the downside protection that it had historically by enhancing your yield. So I still love ZWE, but recently, because I wanted more growth in the portfolio, I switched on the dividend side to ZDI, and that gives me the best dividend payers in Europe and in Hong Kong and Singapore and Australia and Japan. So all of international markets outside of North America. I go back to a more hedged version, a more covered call version when I want to play defense. So BMO's got a couple of dividend ways to play on the dividend side if you're a yield seeker. If you're not a yield seeker and you want pure Europe, Kevin talked about the Europe quality factor, ZEQ, and that's another way to play some of the good quality companies in Europe. And you can buy it hedged or unhedged. Okay. IMF and SDRs. Okay, so these special drawing rights are basically a way for the IMF to funnel money into emerging markets. Everybody is trying to figure out a way to reduce the dependency of the US dollar. And so I'm concerned the US dollar will eventually fail. So the US dollar won't fail because the money has to, when you sell a dollar, you're going to buy a Canadian dollar, you're going to buy a euro, you're going to buy a yen, you're going to buy a Chinese yuan, you're going to buy a South African rand, you're going to put it somewhere. You need a unit of exchange. That if that unit of exchange is Bitcoin, you now have volatility. It may protect you, it may not, from a devaluing currency, okay? But guaranteed you're gonna have more volatility than if you held Canadian dollars in your pocket. So that's one factor. So no, you can't get a bank account in SDRs. How do you hedge against inflation? And gold is still a way to hedge. Real assets are a way to hedge. So things that are real, REITs, things that pay a yield that are real, that have an underlying value of land. So REITs fall into that category nicely. There's farmland investment. There's all kinds of alternative type of lending where you can get a yield off your money and so forth. So, but typically equity in real assets. So infrastructure is a real asset. Real estate or real assets, they depreciate, and you have to factor that in, but they're real assets. Those would be other ways to protect against appreciating currencies. I encourage and help out my children, grandchildren with some savings. The 30-year-old who has a little knowledge or interest in the market. Sounds like my 20-year-olds. My 30-year-old is my son, who's my head trader, so very interested in markets. My girls who are in their 20s have no interest at all. She's quite conservative. She's brand new to self-directed, 6,000. What ETF would you think would be a good starting point? So what I like to, sleep at night, so that millennials love stuff they know, they can touch. Some of these innovative, disruptive ETFs that own companies like Apple, and that would probably be something of growth. So it also depends what the TFSA is for, because I think of a TFSA now. If she's saving for a house and needs that money in 10 years, maybe not necessarily, maximum growth. But I think most people should do their speculation in their TFSAs because you're never going to be taxed on it. And that should be the growthiest part of your portfolio, not the most conservative part. But it sounds like for a 30-year-old, they probably don't have RSPs or a lot of cash savings, and this might be it, in which case you want to tailor it. But think about a balanced portfolio and putting 40% of your money in a bond that is worse off every year after inflation. And so safe and less volatility. Have a look at some of these buffer ETFs. Again, NASDAQ. They have them for the NASDAQ. You can participate in the growth of the economy and technology, but you've got that built-in kind of buffering. That might be sleep at night, modest long-term growth, long-term. Have a look. I like your sleep at night, ZZD for dividends. Do you think that the buff ETFs from innovators? So I can do those things within ZZZD. I can put those buffers in. So right now in ZZZD, I have some protection on the downside to about 3,500 because I don't think we're going to see, because I think if the markets start correcting like that, the Fed's going to step in and will support the markets. I don't think the markets are worth what they're trading at, but that's a different argument. So I think the Fed will be there. They'll underwrite the market. I haven't written the call side yet. So unlike these buffer ETFs, I can be tactical. I can have the hedge. I can have part of the hedge on. So very soon I'm going to write the covered call side because it's the covered call side that pays the premium for the put protection. If you bought put protection and did it every year to protect 15% of your portfolio, you're guaranteed to lose about 6-7% because that's the cost of the protection. But if you write the covered call and take a 6% premium on it, now the protection's free. You give away some of the upside. But you're not giving away the upside typically till you're in the 8, 9, 10% range, give or take. And it depends on volatility and a few other factors as to how those buffers and costs kind of all work. So there you go. GLD or CGL, is it better to purchase physical gold? So if you're looking at gold to hold because you want to trade it, you want to be active, you want it in your investment account, GLD, CGL. CGL is a hedged version if you don't want the US exposure. More than adequate. More than adequate. There are a number of other choices. Some have silver in them. Some have a physical settlement. The reason you want to own physical gold is because you think the world is going to hell in a handbasket. And you somehow think that if you have a bar of gold in your hand, that's your asset. No one's going to take it from you. That's the reason to own physical. I disagree wholeheartedly because if we go Mad Max, because that's the Mad Max scenario, right? Where there's been some kind of annihilation of some sort, your gold bar is worth nothing. Your soybeans are worth a lot. Your gun is worth a lot. Your house is worth a lot. Your shelter, your protection, your food. I'm not trading you my soybeans for any amount of gold. Well, maybe some amount, but so I'm not sure holding physical gold for that reason is a good idea. If you're thinking about trading it, the spread on the physical market compared to the ETFs is night and day crazy different. Now there's an MER for holding the ETFs, but a lot of them are pretty low. You're talking about 25 to 40 basis points a year. Which is going to be cheaper than your cost of insuring it, storing it in a safe deposit box, et cetera, et cetera, et cetera. So all those things come into play. On Berman's call, I mentioned how it may be time to purchase, take some profit instead of deploying new capital. Would I suggest going 5 to 10% cash in the company, sell in May and go away? So how much you go to cash, first of all, I don't know anything about you. I cannot give you a recommendation whatsoever on any degree of amount of cash you should go to because I know nothing about you. But based on my pro eyes indicators, we're starting to get into the area where things are getting bloody frothy. and you don't want to be chasing and being the greater fool here, you want to be cautious. What that means to you and how you affect that trade is up to you. If that means raising some cash so there's some opportunity after markets correct, by all means. How much of that should be? If you suffer from FOMO, then maybe some of these buffer ETFs make sense where you can protect over the next year some degree of downside risk. But if you're wrong and the markets keep getting stupider and stupider, which is a very real scenario, if the Fed comes in and they keep spending bags and bags of money, then the buffers are going to give you a better experience. So that's the answer. Thank you for your insights on the first target trust outcome. So the innovator first target trust outcome. Is it better to wait for a rollover date? So this is where you have to look at what the protection is and what the levels are, how much to the buffer. You got to learn how to read those tables. I haven't been on the First Trust site, but I'm pretty sure they have the similar type of drivers for you there, and so you can do that analysis. And you can figure it out. And sometimes it is better to wait and to make sure you get all the protection. But there might be a buffer out there that was done a few months ago where you still got all the protection today. Markets being at all-time highs, that wouldn't be the case. April would be the closest one. The last one for First Trust was done in January. They only write them quarterly. The innovator ones in the US been out a few years longer. They have monthly series. I don't know what First Trust has the plan to go to monthly. I imagine they do as these things mature, but I don't know their business plan there. I was just looking at my T3 capital. Yeah, so this is a question for BMO, but basically it's not a return of capital. It just has to do with how the ETFs work, and the capital, you get a capital gain from the covered calls. So a lot of the return and distribution, if stocks are getting called away, you're getting a capital gain treatment in your tax. So you get a capital gain treatment from the premium on the covered call, very tax efficient. So you have to look at that. So there's the dividend and there's the capital side. And in a market that did this, there was a lot of stuff getting called away. So there would have been a lot of capital gain. Be very, very clear on return of capital because the yield's not high enough and they're giving you some of your own money back and capital gain. But I would check with BMO. And I believe we had a similar email last week. I'm not even sure if it's the same one. It might be, where I had forwarded that ETF to BMO for them to comment back to this person. So maybe you've seen an answer already. My question is regarding the premiums for options. I've created a practice account. My first options trade buying a naked put on Apple worked out well. I sold the contract in March. And I did not see the premium, just the sale proceeds. Unfortunately, RBC practice account does not seem to show the premium coming on. So so if you bought a put and you sold a put, you're not earning the premium. You're paying the premium. And so what you bought it for and what you sold it for, your profit is going to be the difference in premium. When you're selling and it expires, you earn the premium. So I think you gotta get some education around that and be clear on the terminology here. But I don't know how RBC practice accounts work, and I would call RBC on that and ask them. What are the pros and cons of buying Tesla versus GM? So GM has committed to being all EV by, I don't know, what is it, 2035, 2025, whatever it was. I'd have to look into what their statement was. They're going to compete heavily with Tesla. GM trades at 15 times and Tesla trades at 500 times, whatever. So if you're a value investor and you like that, you buy Volvo, or you buy GM, who are committed to the EV publicly, or you pay a tremendous amount for Tesla. And if Tesla starts losing market share to these other ones, don't know the answer to you, but if I was playing that, would be buying Volvo and Volkswagen, not Volvo, Volkswagen, and GM over Tesla. If you wanted the battery play and the solar panel play, maybe Tesla makes sense, but see. My question on volatility versus future volatility I had last week. Is there any way to turn back the clock on future volatility and see what forward-looking ratio? So I've done a lot of that analysis. And so basically, when we start discounting, when the volatility curve inverts, basically, not to the day, but it does tell you that a risk event, is the market's benign to risk. And those are the riskiest parts, right? But you can't time it to the day and even to the week. It just tells you to be on the alert for it. So if you see that spike in vol, if there's a news event, the Fed says something, a big surprise, something like that, that would be a good trigger to make a trade on the volatility side. I'm not sure if that answered your question. I hope it did. Is that it? I think that would be all the questions. So those are great. Let me go to some of the live questions. We got about 14 minutes left. I was just on the ETFCM website, and there's no way to find the link to register for Kathy Wood's webinar tomorrow. Can you enlighten us? So let me see if I can somehow flip all the way back here without being crazy awful here and go to etfmarketinsights.com to register. Okay, so if that is a way to do that there. Okay.
Larry, the live questions are in your chat.
Yeah, I see that there. Tesla's developed a satellite system that allows people living in poor internet areas to access via Tesla satellite to have better internet service. Something to be said about what Tesla's developing aside from the business, which I assume it was developed for self-driving vehicles. I suspect this might be a good business and perhaps address a better valuation side. Well, this is exactly what I'm saying. There are elements of Tesla that are so new, and the question is, what do you pay for that today? And if you're, please don't take this the wrong way, if you're young and inexperienced, and you didn't go through the boom bust cycles of the past and see that the narratives, the stories, the great ideas, Ballard Power. Okay, Ballard Power was a company working on hydrogen battery technology 20 plus years ago. And it was the bee's knees and every story that came out, speculation. 20 years later, Ballard Power still hasn't delivered. I'm not saying Tesla's the same thing, but the thing is, what do you pay for that earnings? And what I'm saying is, Kathy Wood has some very innovative ways to value those things. And I don't. I'm not that guy. I'm the chart guy that tells you how to trade that and manage risk, right? So great question. Excellent point. Doesn't matter, right? Do you want to trade it or do you want to own it? And as a value investor, I'm not going to own that here. It's not value to me. If it's value to you, great. Okay. It's not value to me. I would rather own GM or Volkswagen if I believed in the future and those companies and their products. They're not probably going to have their own satellite networks. They're not integrated as much with batteries and so forth. There's a lot of reasons why Tesla might be the winner here. and you want to pay more. But do you want to pay 5 or 10 times sales today? Because these companies were trading at 5 and 10 and 20 times sales in 2000. And 95% of those companies don't exist today. I'm not saying that's Tesla. But in 2019, Tesla bought debt was trading at 50 cents on the dollar. So pardon me for pushing back a little bit here on how to value a company and what you should pay for it. But that's just me. So no disrespect at all. Your points are very, very well taken. Okay, would I ever buy an equal amount of ZPay and ZPayF, hoping for a currency neutral long-term hold? Great question. The answer is yes. The answer is yes. So, and I would actually go back and forth. Again, you take a range. So ZPay gives you exposure to the US dollar within the ZPay ETF, and ZPayF is a currency hedged version of that. 50-50 means that if the Canadian dollar goes one way against you, you're hedged with the F series. If it goes the other way, you benefit by having this US dollar exposure into ZPay. So it's kind of like market neutral, but it really isn't. Market neutral is ZPayF. That is, I get pure exposure to the underlying factor on what ZPay is designed to do, generate the yield with a lot less volatility, and not worry about the currency. Historically, Canadian US dollar, going back to Bretton Woods, 1971, where currencies were fixed to gold and the US dollar, and currency started floating, the Canadian US dollar, the absolute value of change in the Canadian US dollar exchange rate, plus or minus, absolute value of change, 4 to 5% annually. So it's going to help you in some years on average and hurt you on other years on average. So that's a great way to do it between those. So you have to have a view on the currency. And so for the next year, my guess, best guess, 120. So call it 83 cents-ish. 135. Call it 74 cents. You want to tighten that up a little bit? Sure. At one side of the range, I want my ZPay. The other side of the range, I want my ZPayF. But that's a great question. To date, Bitcoin and gold have been mirror images of each other. With Bitcoin going up and gold going down, would you be willing to buy Bitcoin? And if so, which one? Would I be willing? No. Should someone do it? Completely different case. So Bitcoin's going to have, historically, a multiple of volatility that gold is going to have. It's going to have 2 to 3 times the volatility, measured by standard deviation of returns, of junior gold stocks. So it's volatile. It's been kicking butt on gold for a while. It may continue to do that. Am I going to make that trade? No. Am I going to recommend you make that trade? No. But here's why you would do it. Because you want a lottery ticket. You want something that maybe everyone in the world is going to buy 1 or 2% of before the central banks of the world and legislation gets rid of what Bitcoin is. You know, so I ultimately think it gets legislated away. But again, that's just me. Are banks going to have their own digital currencies? Absolutely. Most of the reading that I've been doing in the last 6 to 12 months has all been, well, not most of it, but a huge part of it has been on what is the world going to look like when we get rid of coins and paper and we go to an all digital world. Central banks have accounts and that whole like what if scenarios around all of that. And then but Bitcoin and independent, these might be crypto assets, not currencies, crypto assets that may exist in the future. People say they're going to stabilize. I think Bitcoin's worth nothing. There's no yield to it. There's no way to value it, but it is a textbook example of contained supply and demand curves going wonky at any point in time. Should you do it? It's up to you. Is it too soon to get into uranium? So I bought Cameco, one of the stocks I like, and I bought it very recently as well, within the last month, into the portfolios. Talked about it a few weeks ago. I think mass scale global greening is going to demand a huge increase in investment in new technology, nuclear power. I think it's essential that that happens. So very, very bullish on it. We have to get off coal as fast as possible. We have to lower the carbon footprint globally. Uranium is a great way to do it. Website for BMO ETFs that Larry runs. So ZZZD is the only ETF that I run for BMO. I don't run any other ETFs for them. I do consult with them on products and what ETFs that I could use and what I think the marketplace could use. I give them feedback from BNN viewers. So I consult with BMO on their product line on a quarterly basis. Kevin, who's the managing director of BMO ETF sales for all of Canada, is a key part of that committee that I talk to. But there's no website of BMO ETFs that I run. Okay. Question on this XLE. It's pulled back almost 10% in the past few weeks. What's my view? Well, so today I sold a little bit of S&P 500 and I bought some XLE into my growth and balanced BMO funds that I run. We run algorithms to buy them. So I say, okay, below this level, I want to accumulate a position. And so we put that level out there today. And as long as it traded below there, I bought it. So I ended up buying about half of what I wanted to today. I was going to add 1% to my growth fund and 0.6% to my balance fund, because the balance fund's a 60-40 target and the growth fund's 100% equity. So that's the 1 to 0.6 ratio. And we ended up buying half the position and we sold the S&P 500 on the other side. So we will tactically move into sectors on relative strength pullbacks on sectors that I like and I'm bullish on fundamentally. A few weeks ago, we were going the other way. We were lightening up on energy when they were much higher so that when they pull back, we can add. So we're always doing that. We're in and out, we overweight, we underweight, we move around in the themes we like. Question, if I were to invest in UK ETFs, what would I use, hedged or unhedged? So EWU is a unhedged, gives you exposure to the US dollar, British pound. HEWU is the hedge version, or would I go half and half? I like the British pound. I think it normalizes over the next 5 to 10 years after Brexit, as they reestablish trading relationships and normalize behavior with Europe and kind of start regaining their financial center. And so I want exposure to the British pound. And so I would go EWU. What portion would I allocate to small caps versus large caps? Again, great question. I've got both in my growth fund right now. I like small caps in the UK over large caps, although I just went the other way, because when you look at large cap, you have a value tilt. You have energy names, right? You have Shell and BP, big weights. You have big weights in HSBC, right? So big bank. So value is banks and energy names, and I like that factor now. So I sold some small cap to buy some EWU. I move it around. There's no one right answer there. So, half, sure. But I like small caps a little bit better for growth. One of the cheapest sectors and asset classes on the planet is UK small caps. How do I feel about clean energy ETFs? They've pulled back. I've been nibbling on the pullback. They do fall into the category of new and disruptive technology and somewhat fundamentally overvalued. They're small positions for me in my growth and balance funds right now, but I do like them and I would be adding on pullbacks. I think the 10-year picture looks really good there. And we're at 8:30. So thank you so much, folks. Go to etfmarketsinsight.com. If you can spend a half hour, I think you'll really enjoy hearing from Kathy Wood and how she looks at some of these companies and values them and what ARK ETFs are all about, and the BMO ZINN ETF, the new Kathy Wood index-based ETF. Have a great week, everybody. See you next Thursday. Go Leafs, go. #1 in the NHL. I knew it. It's their year. Okay. Have a good one.